So to finish off this section then, you could have a go at that practice question. It's a lot easier than the two that I've debriefed for you. Remember, you've got your written answers on Moodle that you can check with, so you should be okay with that one on its own. We don't need to do anything else on loan relationships. And a lot of what you've got on here, we have already covered during the questions that I've done with you. So we have already talked about how any company other than the large companies where their profits exceed the 1.5 million, you'll pay 9 months and a day. And if you are a large company, how you pay it instalments. All companies must file a tax return, and if they don't do these things on time, there are various fines, as you can see there. So you can have a read through what the dates are. In the last question that I did with you for Ballpoint, I showed you how to do the quarterly instalments. So where you test that augmented profit, which is that total taxable profit and dividends received, if it's above 1.5 million, then you will have to pay instalments. And there is actually a worked example here of how those instalments work. All right, how you work out what the tax is, and then you just divide it by 4, and then how the dates work, as we can see here. All right, so have a look at that if you weren't quite clear with what we were doing in the Ballpoint question. There's also an exception to the instalment. So even though you might be a large company, if your tax liability is less than 10 grand, you can just settle it in one lump sum. So this will be a company whose profit isn't actually that big, but they're pushed into being a large company because they have a lot of dividends received. If your accounts are not for 12 months, then they use this special calculation here to work out what the instalment should be. So there's a worked illustration there that will help you with that one. And then here there's just a bit of detail, which really you just got to memorise in terms of, you know, what dates things need to be sent live, what deadlines they are. This here is quite relevant for anybody who might be applying for any tax jobs. So if you're looking for a tax placement or maybe planning when you graduate, have a little look at this. I just sort of Google it online as well, because this is quite up-to-date information in terms of electronic assessment. So employers, potential employers might ask you about that. So the bit that I'm actually going to finish off going through is a capital gain for a company. It's basically the same as an individual. So you say, what did I sell it for? What the costs I can deduct. So cost to buy, cost to sell, any enhancements, that sort of thing equally applies. But what's different is a company pays tax on their gains, not capital gains tax. They also have no annual exemption, and they don't get any of those reliefs that we saw for individuals like principal private residence, because obviously that's your main home. Companies aren't going to see that. And companies don't have any gains on goodwill. So individuals would pay tax on goodwill, but not companies. So the main thing really is this indexation allowance that I want you to look at, which is itemised here. And this is basically some relief against inflation. So the way that it will work, you'll have your proceeds and you'll have your cost, which you'll deduct whatever costs you're allowed to do. And then you'll have this annual exemption, indexation allowance, and that's what will reduce your gain. So rather than the annual exemption, you have the indexation allowance. Now this indexation allowance, it was abolished in December 17, so you won't get any after that date. Now that doesn't mean that if you sell anything after December 17, you get no allowance at all. What they do is they work it out of what it was actually up to that date. So if we look at this formula here, which I'm going to highlight, you work out the movement in retail price indexes between when you sell the asset and you bought it. So let's say you bought the asset in January 90, you would index that up to the disposal date. Unless the disposal date was after December 17. In that case, you would index up to December 17. So it's the movement between when you bought it and when you sell it. And then you divide that by when you bought it. So these retail price indexes are what we use to calculate inflation. I'm sure you've seen it in your economics. And we calculate this factor. So it gives you usually 0 point something. It can be 1 point something if it's a long period of time, but it's usually 0 point something. And we always work it out to 3 decimal places. And what we use that for is we index the cost and we say, right, it might have cost us, say, £10,000 when we bought it, but because of inflation, we're going to get another £3,000 of relief, because if we'd bought it later, it would have cost us more. That's generally what you're trying to do. So we've got a pro forma over the page. It does point out here, indexation cannot be used to create a loss. So if you've not got a profit or a gain, you won't calculate indexation allowance. The idea is that it will reduce the gain to 0 in the best case scenario. So you're working out your usual proceeds and costs, and then this is the new bit. So this is where you get to when you're an individual, and this is the extra bit that you're going to do for a company. They might get some reliefs, but none of those are on your syllabus, so you're not going to have that. You're just going to finish with the gain after the indexation. So let's just finish off with a couple of examples then of how this actually works. So in 16.7, we sell the asset for 24,600, and we originally bought it for 10. So we start off just the same as an individual, deduct the proceeds and the cost. So proceeds, 24,600, and the cost is 10. Because it's a company that sells the asset, we're going to get this indexation allowance. And we're going to index from when we bought it, which is May 04, to when we sell it. However, we sold it after December 17, so the maximum we can have is up to December 17. So this is the factor that we want here, right? We want to index from when I bought it to December 17. The retail price indexes still carried on, which is why there is a factor quoted, but we're not allowed to have relief after December 17. So we're going to use the 0.491, and we're going to multiply it by the cost. So it's this £10,000 that you get in relief. We're saying I bought it for 10 grand, but because of inflation, I'm going to get some extra relief, which is 4,910, and that will give me a gain of 9,690. And what I will do with that is that when I'm calculating my corporation tax, I'll have my trade profit, and then I might have a capital gain of this. So it just gets added in with all your other income. The last question, 16.8, is giving us 3 scenarios. We buy the property for 50,000 and we're going to sell it for a variety of options. So we want to compare how things are going to change. Now, first thing I'm going to do is I'm going to write down the 3 options side by side so we can see what the position is for each of them. So proceeds will be 90, 55 or 48. We've also got a cost, which is 50. So the cost stays the same. And then the next thing I'm going to do is I'm going to net it off to see where I am. So I've got a profit of 40. I've got a profit of 5. And the last one, I've got a loss. And now I want to work out indexation. So indexation is going to be calculated from when I bought the asset, which was February 2002, to the disposal date, which is deemed to be the maximum of December 17. So I'm going to index from February 02, which is this one, up to December 17. So I don't need that figure. It will be quoted because they're testing to see if you know that's the rule. Now, this time, I've not been given my index factor, which rounds to 3 decimal places. So I've actually got to work this out myself using that formula. So the formula is the RIP at disposal less acquisition divided by acquisition. So if we have a look at this, so the index factor when I sell it, in fact, let's just do a calculation down here. So our RPI at disposal, which is deemed to be December 17, minus acquisition divided by acquisition. So that's what we got there, 278.1 minus 173.8 divided by 173.8. So that gives me an index factor that I want to calculate. So 278.1 minus 173.8 divided by 173.8 gives me 0. Pretty much 600, isn't it, to 3 decimal places. So I'm going to use that factor to multiply by the cost, which is 50,000. And if I do that, that gives me 30,000. So in the first example, the gain is reduced to 10. So what it's saying is because inflation has moved between these dates, effectively 60%, that's what 0.6 means, because things have gone up by roughly 60% since these dates, then something that cost me £50,000 a number of years ago would now cost me another 30. There are other factors that of course affect prices, but that's one. Now with the second one, I can't deduct 30 because that would turn a gain into a loss. And as it said up here, indexation cannot create or increase losses. So the most relief that I can get on that second option is the maximum of 5,000 to reduce the gain to 0. And in the third option, I won't get any indexation because I'm already making a loss. So it will stay at 2,000. So that gives you a bit of assistance there on how to deal with capital gains with companies. It's pretty much the same, proceeds and costs. This is really the only new bit, and it just all gets thrown together with all their other income. So in terms of revision of what you've done in this chapter, a lot of it is just repeating what you've learnt already. I would strongly recommend that you go over these bigger questions again. So the 2 big ones that we did, where we looked at sort of exam technique. So we had ballpoint, and the one that we had before that, which was IPON. And I would remind yourself all the rules of how to do your adjusted profits, recap how you calculate your capital allowances to get down to that adjusted profit, and then move on to how you calculate the tax and how the general principles of payment work. I think if you're good at those areas, then any other little bits and pieces they might throw at you, you'll be able to find your way through it. But certainly in any main exam question that's on corporation tax, you're going to have to do those elements. So have a little look at those again, make sure you're happy with them, and then maybe go over the recordings a couple of times.